Imagine waking up tomorrow to find the government just outlawed your entire investment portfolio. Poof! Your assets? Illegal, overnight. Well, that's exactly what went down on Wall Street in 1861. But while the nation was literally tearing itself apart, a tight-knit secret group of traders realized something kind of terrifying. The bloodier the battlefields got, the richer they could become.
And because, look, before the first shots were even fired, the American financial system was basically hanging by a thread. I mean, Wall Street was so incredibly thin and fragile that one major political shock could just wipe it off the map. And then, late 1861 hits. The Treasury Secretary unexpectedly drains private bank reserves to fund the military, and it triggers this massive, cascading panic. Banks across the entire country just stop paying out physical gold. Period. And to make matters worse, the New York Stock Exchange instantly bans the trading of all Confederate securities. Millions in investor wealth evaporated overnight. The government was staring total national bankruptcy right in the face, and the markets were in an absolute freefall.
But right when the financial system is bracing for total collapse, the government pulls a radical, desperate move. To fund the military, they just flood the economy with unbacked paper money. And the market? It mutated instantly. We're talking about sleepy, zero-volume auctions transforming into a multi-million-dollar continuous street casino. Traders completely threw corporate earnings out the window. They were trading purely on wartime fear, inflation, and raw, psychological greed.
In February 1862, the government drops an absolute financial bomb called the Legal Tender Act. They printed $150 million of a brand-new paper currency called the greenback. And here's the kicker. It wasn't backed by gold. It was backed by absolute faith. By the end of the war, over 450 million of these paper notes had flooded the streets. The result? A massive, unprecedented wave of hyperinflation that literally forced regular, everyday citizens to turn into degenerate stock gamblers just to survive.
Think about the real-world portfolio impact for a second, because it was devastating. Suddenly, the price of basic household goods and commodities, like corn, skyrockets by nearly 100%. If you're an average citizen holding on to traditional paper currency, your purchasing power was being violently cut in half. Holding cash became a guaranteed way to lose your life savings. If you wanted to feed your family, you couldn't just safely save your money anymore. You had to aggressively deploy it into the market.
Now, because these greenbacks were bleeding value so fast, physical gold became the ultimate safe haven. But betting against the government's paper money? Yeah, that ruffled a lot of feathers. The New York Stock Exchange actually stepped in and banned gold trading entirely, labeling it unpatriotic wartime speculation. But come on, we know how markets work. When you ban a highly demanded asset, it doesn't just disappear. The real chaos simply moved underground.
All these traders just relocated to a parallel, chaotic trading floor known as the gold room. Picture this, an unregulated basement casino where the price of gold was basically a real-time ticker of the war itself. If the Union lost a battle, gold surged. The volatility was absolutely insane. In May 1864, two journalists actually pulled off a fake news hoax, publishing a forged presidential draft proclamation. That one single rumor sent gold prices spiking 10% in a matter of minutes. You could literally become a millionaire by noon or find yourself completely bankrupt by the closing bell.
Desperate to stop the madness, Congress steps in with a heavy-handed ban in June 1864, trying to shut down street gold trading entirely. And it was a catastrophic miscalculation. The exact moment they tried to outlaw the free market, street trading exploded anyway, and the price of gold surged to an all-time high of 285% over its par value. It was such a disaster that Congress had to embarrassingly repeal the law just 2 weeks later.
Destroying the retail investor. The forced conversion.
Throughout this entire era, Wall Street was fracturing into a literal psychological war zone. On one side, you had the bulls. They were aggressively betting that endless wartime spending would create this permanent new era of corporate giants, basically using inflation to drive asset prices up forever. On the exact opposite side, the bears viewed the whole thing as a giant house of cards. They were screaming about total insolvency, massive debt, and a devastating deflationary crash the exact second peace was declared.
And the bulls were utterly ruthless. The war machine was triggering an explosive tech boom in infrastructure, and elite operators realized they could just corner these rapidly growing markets. In 1864, legendary short seller Daniel Drew bet heavily against the New York and Harlem Railroad. Well, Cornelius Vanderbilt steps in, and he completely traps Drew in a brutal stock corner. Vanderbilt drives the price from 90 all the way up to 285 in just 5 months, ripping $500,000 straight out of Drew's pocket. I mean, it was an absolute slaughter.
But don't feel too bad for the bears, because anyone betting against the Union got completely wiped out during a pivotal moment we call the July 1863 deflection. The twin Union victories at Gettysburg and Vicksburg instantly changed the market's calculus. Traders suddenly priced in a shorter path to peace. This caused the greenback to appreciate violently, and that massive gold premium, it completely collapsed. International capital saw the writing on the wall and flooded directly into northern bonds, heavily punishing anyone who was holding gold or shorting the Union's financial survival.
As the war drew to a close, smart money institutions were already looking way past the battlefield. They were front-running a massive economic reallocation. Forward-thinking capital totally abandoned the old textile mills of New England and pivoted heavily into transcontinental railroads, which suddenly made up 58% of the entire market. We also see the explosive emergence of financial powerhouses, taking up 23% of the market cap, which laid the groundwork for modern investment banking titans like Drexel and J.P. Morgan.
And the ripple effects of this massive capital shift, they were entirely global. When the Union blockade cut off Southern cotton, global supply chains just snapped. This sparked a massive, highly speculative stock bubble, all the way over in Bombay, India. But the moment Robert E. Lee surrendered in 1865, American cotton was set to return to the global market. That global bubble in Bombay popped instantly, bankrupting merchants overnight, thousands of miles away. It was a true global financial contagion.
Ultimately, looking at the structural legacy of the 1860s market, we see a pretty profound truth. The financial machine never stops running. It simply redirects capital without an ounce of morality. Whether it was the underground gold room, the brutal railroad short squeezes, or global cotton bubbles popping in India, the market adapted to chaos by relentlessly finding the next most profitable trade, completely regardless of the political or human cost.
Which brings us to the ultimate reckoning for our own portfolios today. Looking back at the chaos of the Civil War fiat rollout, the rapid expansion of the greenback, and the way it forced ordinary citizens into dangerous market speculation just to survive inflation, you really have to ask yourself, when a government rapidly expands the money supply today, are you actually investing for fundamental economic growth, or are you just desperately trying to outrun the exact same fiat inflation trap? Drop your thoughts on where you think we are in the modern cycle down in the comments below.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.